I'd like to introduce Danny Frederickson and Emma Mueller of Wealth Enhancement Group. They are located in Madison and offer comprehensive wealth management services. They also manage Groundswell's investment fund and have been our partner for over a decade. So now I'll hand it over to Danny and Emma. Thank you.
Great, thanks for the introduction. So a part of, hopefully you guys can see the screen we are sharing today. As Ben mentioned, I'm a financial advisor here at Wealth Enhancement Group alongside Danny Frederickson. And today we'll go ahead and look through the overview. Today we're going to be talking a little bit about charitable giving. And there's our beautiful faces. And then here we have the overview. So again, how we are involved with Groundswell and Wealth Enhancement Group. We're going to go over some gifting strategies to discuss in more detail. And then action plans. So what would you need to do going forward? There's multiple different action items that can be taken place. So we'll go through that in more detail in a couple of slides. And as Ben said, we'll have some questions available for time after. The steps to intelligent and impactful giving. So first and foremost, understanding the mission, determining the best ways to maximize your support, and of course, stay connected with the organizations, in this case, Groundswell.
Yeah, so understanding the mission, Groundswell's mission, we protect special places forever. Pretty simple and easy to understand vision there for Groundswell. Determining the best ways to maximize your support. So there's a couple of ways we can do it that are not just financial giving, volunteering your time, spreading the word, and then of course financial giving, which is what we're here to talk about, and the best ways to do that. So there's a few benefits of giving. One is donating to a charitable organization can help reduce your income tax. So you can take deductions and lower your income tax. You can strategically bunch your giving in a certain calendar year to reduce your income tax in that calendar year, which can provide for long-term planning. And then for those who are 65 and older and looking to do gifting, it can affect your Medicare premiums, because Medicare premiums are tied to your income. So if you can gift, you can lower your income, which can also help improve your the premiums that you pay for Medicare.
So there are 4 different ways that you can maximize the financial support, specifically to Groundswell. So you can itemize and bunch your deductions. We'll get into that in more detail. You can donate your RMDs. Those are your required minimum distributions that have to come out of your IRA upon a certain age. You can donate appreciated assets. So if you have brokerage accounts outside with a custodian such as Charles Schwab or Fidelity, you can donate appreciated stocks. And then you can donate through a DAF or donor advised fund. So we're going to go into details with all 4 of these options.
Yeah, so the first one that we talked about was itemizing and bunching deductions within a calendar year. So if we just look at example A and example B when you file your taxes, so we're in that time of year right now. In example A, we have $10,000 of state and local taxes. We have $4,000 of mortgage interest. If we just take those as our itemized deduction, we're going to have a $14,000 deduction to take. Well, if we're married filing jointly, we have $29,200. So we're going to take the standardized deduction. That's going to be the one that we choose. However, if we look at example B, we still have $10,000 of state and local taxes. We still have $4,000 mortgage interest deduction, but we made a $25,000 charitable donation within that tax year. So we have a $39,000 deduction that we can take in this year because of that charitable donation. So versus our $29,200 standard. So of course we're going to take that $39,000 because that gives us another $10,000 reduction in our income. Right there. The second part is donating appreciated assets. So if you think about those stocks, the Microsoft stock that you bought in 1995 and how far it's come to today. So in this example, we have stock XYZ, which we paid $5,000 for way back. Now it's worth $20,000. So 20,000 minus 5, we have a $15,000 gain on that stock. If we were to go ahead and sell all 20,000 of that stock, we would be responsible for paying taxes on that gain amount. So we'd be responsible for paying taxes on $15,000. That's at 15 to 20%. We'll call it 15% in this example. So given this example in the top line, if we sold all 20, we realized 15,000 of gains. We paid the taxes on that 15,000. We'd be left with 17,750 after we paid the taxes on our $20,000 position. If we wanted to give that amount, Groundswell would only receive 17,750 on a net basis because we had to pay the taxes. The more tax efficient way to do it would be to directly donate that stock. So again, same situation, except we take that XYZ and we just send it to Groundswell. We donate that stock. And then they receive the full $20,000 and we get a $20,000 tax deduction. So we get the tax benefit from that, from gifting that stock. And then the Groundswell or the charity decides if they're going to keep that stock or go ahead and sell it. In most cases, a charity will just decide to sell it, take the cash and then use the proceeds for their operations.
In this case, it's more of a win-win, right? So you're not having to pay the taxes on it, and then the donation goes tax-free, and they get a higher amount.
The next part that kind of ties into that donation of appreciated stocks is a donor advised fund. So for those who are looking for those maximum contributions or maximum gifting strategies within a single calendar year, donor advised fund is a great way to do that. And what that is you open an account and you say, I have a bunch of Microsoft stock, it's highly appreciated, I don't want to pay the taxes on it, but I want to give. So some of our clients might say, I have $100,000 of Microsoft stock, and I don't necessarily want to give the charity of my choice that $100,000 in 1 year, but I want to spread it out over the next 10 to 15 years. So they'll take that $100,000, put it into a donor advised fund, take $100,000 deduction tax benefit in that single calendar year, and it'll sit in this account, but then they can gift from that account as long as that money's in that account. The other benefit to that part is once it's in the donor advised fund account, you can still invest it. So it still has a chance to grow. And then so that as a way to make your gift last even longer with the calendar years. It's a really powerful tool. A lot of our clients use it. It's really beneficial to their gifting strategies.
And one other thing to note is we get sometimes asked, well, what custodian should I use for a donor advised fund? And again, there's the big players out there, the Charles Schwab's and Fidelities of the world. Depending on which custodian you use, we are able to tell you if they in fact do have a donor advised fund program. And it is something we can help facilitate getting you the right contact number to whether or not the custodian you use for your investments does have that option to be able to then use the donor advised fund for Groundswell.
And one of the things too is at the end of, so let's say that you have money left and you were to pass away, you can actually name a beneficiary or multiple beneficiaries on that account. So you can say, I passed away and there's $10,000 left in here. Well, that $10,000 is then going to be given to who I name up my beneficiaries, Groundswell or any other charities. The fourth one and probably the most common or the biggest one is going to be qualified charitable distributions. So required minimum distributions, that's the amount that the government is at age 70, was 70, 72, now 73, will be 75. At your RMD age, the government is saying, you've deferred the growth on these assets long enough. Now it's time to pay us our taxes. We need to collect our tax revenue on this. So you're required to take that money out, pay the taxes on it, whether you need that money or not. So typically how an IRA RMD would work is you would pull it out, you pay the taxes, you either use the money, reinvest it, or give it. So in the first example on the left-hand side of the screen, it's your IRA RMD, required minimum distribution. You take it, you pay the taxes on it. And similar to our donated stock example, you would pay the taxes on it, but then if you wanted to donate it, that gift would be lessened by the amount of tax that you had to pay. The better strategy is to do what we call a qualified charitable distribution. And that's a distribution from your IRA that you designate to go to a charity. It goes directly from your IRA to Groundswell or to that charity. It completely bypasses you. So it goes directly to them. No taxes are paid on it. The Groundswell or the charity gets the full benefit of the gift, and you receive the tax benefit. You receive that reduction in your income.
And just one thing to note on that as well is it's not your entire RMD that is required to go. So oftentimes if you have a large RMD and you want to give to multiple charities or one charity or use some to spend, of course, throughout the year, you can specifically designate a certain amount that you would like to go through to the charity through the QCD program.
And so I mentioned the different ages. So at age 59 and a half, you can start taking distributions from your IRA account. At age 70 and a half is when qualified charitable distributions can start. So you can start doing these qualified charitable distributions and taking that tax benefit at age 70 and a half. And then the new rules at age 73 and eventually at age 75 are when the new required minimum distribution ages have started. If you're already in your RMD stage, you'll continue to be in your RMD stage. But what Emma was just alluding to is at age 72 is the lowest amount. Let's say you start taking your RMD at age 72. So 3.9% of your $1 million IRA account has to be distributed to you. So you're required to take $39,100 and you're required to pay income taxes on that amount. Every year though, that amount gets higher and higher and higher. So you can see by the time that you're 80, instead of taking 39,000, you're now taking $54,800. So it continues to grow. And if we think about our spending patterns, a lot of people envision their retirement spending to look like the left-hand chart, where I retire, I'm going to be spending the most of this because I want to maintain the lifestyle that I'm used to. But then as I settle into retirement, I'm going to kind of linearly decline until the end of life. And then I'm not going to be spending anything because I'll be too old to do anything. It's a little bit different in reality from what we see is that at age 65, a person retires and then it's, okay, I want to do this, 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 and this, and I want to travel here, here, and here. So spending tends to increase within that first couple of years. Then you start to find your rhythm in retirement. And then as you age to the later years into your 80s, you're not really spending as much. And then towards the end of life, expenses spike again, because that's when all the health issues start to arise. So that spending increases. So if we take those last two charts and just overlay them on top of each other, we end up with this dilemma where we have extra income, but we're not spending that income. So we're required to take that income out and pay taxes on it, but we have nothing to do with that income. So that's where really the power of the qualified charitable distributions come in, because what we can do then is we can say this extra income that I'm required to take out, I don't want to pay taxes on it. I don't need it. I want to send it to charity, send it to Groundswell, and they won't have to pay taxes. My impact will be bigger. And so on and so forth. So if we look at the chart on the right hand side, $50,000 gift, we pay $15,000 in taxes. Our final gift would be $35,000. Well, if we do the qualified charitable distribution, obviously we pay zero, so we get the full monty of that. Finally, just a recap of QCDs. So at age 70 and a half is when you can start doing it. It's a direct transfer from your IRA account. Again, do not take possession of it. It's a direct transfer from your IRA to the organization and your advisors, or we can help with that as well. And then it's up to $105,000 annually. So that's a pretty significant gift. And now it's indexed for inflation. So that number will be adjusted on a go forward basis. Like Emma said, it does count towards your RMD. So you can reduce your RMD amount by doing that. It reduces your income. It may reduce your Medicare premiums. Again, Medicare premiums are tied to the income piece. And then it creates that potential for the standard deduction versus itemized deductions that we covered at the beginning of the presentation.
One thing I also wanted to address is, yes, it's from traditional IRAs that you can take these qualified charitable distributions from. In particular, in this day and age, we do have clients that are receiving inherited IRAs. So under the new rules, you have 10 years to take out the full amount of the inherited IRA. So oftentimes, if you are receiving that inherited IRA at a point in which your taxable income is higher, and you're not wanting to necessarily pay a higher increase your overall taxes for that year, you can use the qualified charitable distribution as a way to distribute from an inherited IRA as well. So staying connected with the organization, we'll get into the next slide, Danny, if you want to move forward. So following up, so find out how your financial gifts are currently being used, determining a long-term gifting strategy. So working with your advisor, say, okay, well, this year I'm going to be doing, my RMD is X, therefore I want to give a certain amount to Groundswell and a certain amount to another organization, and I need a certain amount for income needs throughout the year. And then start giving more than just financial support. And we kind of talked about that a little bit, whether it's sharing out in the community, information about Groundswell, just talking to others about it is going to be key to keeping the discussions live and free. Consider adding Groundswell as a beneficiary to your IRA and of course becoming a legacy circle member. So what this is really important. So yes, we talked about the donor advised funds. We talked about the charitable gifting and the appreciated stock, but it's really important, and we have quite a few clients that come to us and say, okay, well, I have this IRA, I don't want to give it all to my kids, they have enough, or I don't have any kids, you know, whatever that may be for that particular individual. But we can designate all or some of a percentage of an IRA specifically to an organization such as Groundswell. So if someone wants to say, I'd like to leave 100% of my IRA to Groundswell, I want to leave 5%, I want to leave 200,000 of my IRA to Groundswell, you are able to designate a specific beneficiary. So do consider that as an option. And as it mentions in the second piece there, it's designating a certain percentage and or dollar to Groundswell may be an option. So it can be whole or part of the IRA. So if done properly, charitable donations of a retirement assets can minimize the amount of income or taxes imposed on you in that given year, and as well as your heirs going forward. So recap, so using QCDs and qualified charitable distributions as a gift as part of your tax planning strategy. So if you have an advisor you work with or you have questions on that, reach out and we can assist with that. Consider naming Groundswell as an IRA beneficiary. So for all portion of your IRAs, and keep in mind that also includes any inherited IRAs and or 401ks or 403bs as well. Establish your own donor advised fund to meet the current and future charitable gifts. Again, you talked about that planning aspect. You know, how much are you going to be giving year over year? Having a donor advised fund where you can contribute assets to throughout the year, with various custodians, whether that's Charles Schwab, again, and Fidelity, wanting to make sure you have something established, and then donating the appreciated stock from your brokerage accounts. That is an option. Working with your advisor is key, of course, because there's strategic tax planning that comes into play. So we as financial advisors, we are not tax accountants, but we do work in conjunction with accountants to make sure the donations are going to good use. So with that, we will turn it over to Ben to see if there's any questions from those on the call today.
So we didn't get any questions in the chat, but if you have any questions that you'd like to put in chat now, or turn on your audio and speak up, we're open to questions now.
Yeah.
My parents are, they just lost their last parent, so they're kind of like dealing with everything with that, and now suddenly they're like, oh, we should probably figure things out for ourselves.
Yeah.
And I keep like pumping resources their way, like, oh, maybe you should like, here's some like estate stuff to look at. But as financial planners, like what services are you able to offer someone in that age category? Like can you, I know you say you're not tax people, but like you could help them figure out their charitable distributions, but you could also kind of guide them in estate planning.
Yeah. So part of what we do at Wealth Enhancement Group, of course, we are financial advisors, but we're more holistic planners. So we're looking at everything. So whether it's your estate plan, your taxes, and of course your investments, is kind of looking at all pieces, because you can't really do one without the other.
Sure.
So it is part of the process, and most financial advisors in the industry are also doing that. So it's really just kind of getting a game plan what was possibly inherited, and then how to distribute the assets, how to use them in the most tax efficient way.
Okay, yeah, holistic, that's what else.
Yeah.
They're very like DIY, and I'm like, well, maybe with someone who can have.
And DIY works for a lot, for a large portion of, when you're in accumulation phase, right? It's when you're in that distribution phase, or when you've kind of accumulated all of this and now you're like, what do I do with it? How do I use this in the most efficient manner? And that's usually when people come to a financial advisor for that extra advice.
It's typically in that age category where I'm earning the most that I've ever earned, and now I've got all these complicated factors. My parents have passed away, and I have much money from them. So
Yeah.
a lot of our clients kind of say, I've been doing it myself for a while, but this is just getting
I've got
complicated.
grandkids, I've got this, how do I plan? And it's that aspect of it. Yep.
That makes sense.
And a lot of that is the charitable piece, right? It's I'm so lucky that I have this, I've amassed this, accumulated these assets, how best to distribute. Yeah. Any question?
We have a question from Heidi. How does making a charity the beneficiary of a DAF differ from making them a beneficiary of an IRA?
I don't think there is much of a difference between the two. If you name the beneficiary of a donor advised fund, upon your passing, whatever percentage you designate on the donor advised fund is going to flow to that organization. And same thing with the IRA, whatever percentage you designate within the IRA, it's gonna go flow directly to that organization.
Yeah, good question. They more or less are the exact same when it comes to the beneficiary designation.
And we have a follow-up, are there RMD requirements with an inherited IRA or just that must be taken within 10 years?
This is a tricky question because yes, they're supposed to be, but nobody's tracking it under the new rules. So we typically recommend you take out a portion. There's a number, there's a calculator under the old rules, but there was certainly an RMD that was required. Now, based on the Secure Act 2.0, we do have 10 years to take the distributions out. There are annual RMDs that we are recommending. They, however, are not being tracked at this time by the IRS.
And the inherited IRAs now, if you inherited it post 2020, it needs to be depleted within 10 years. So just making sure that at that 10-year mark, that account balance is zero.
Yeah.
And again, if you don't have no need for the income, and a lot of like your parents, they're in their peak earning years and they have a lot of income already, they inherit something, but now they're required to take it over 10 years. Well, that's just compounding their tax problem. So donations from inherited IRAs is a good strategy to kind of manage that tax piece.
And with inherited IRAs in particular, because of that 10-year time frame, what we don't want anyone to do is in year 9 or 10, realize, oops, I have to take money out, and then have a big tax hit to them in that year. That's why taking and running those calculations of the RMDs and additional distributions in those years, year 1, 2, and 3, et cetera, is really going to be important. But we do encourage clients to take out from inherited IRAs as with an RMD calculator. It's just, we can't promise that it's being tracked by anyone other than yourselves and the advisors.
I have a question on charitable giving tied to Medicare premiums. Do you have to give like a pretty significant amount to actually lower your premiums, or could you give like a modest, like a few $1,000s a year? And
It really depends. So it's the income ranges are bracketed. So if you are, and your advisory again can help, or accountant can help work through this just to look at it. It's a 2-year look back period. So what that means is when you turn age 65 and you start your Medicare premiums, it's going to look at your income at age 63. So it's really managing as you get towards Medicare, managing the income 2 years prior, because they're going to look back and charge you the premium based on your income 2 years prior. So let's say you're age 67 or we're at age 65 and we're planning for age 67. You can start making those charitable distributions, lowering your income in that year. So at age 67, when they look back at age 65, it's a lower income level because you get that deduction.
Okay. And sometimes we do have clients that come to us, what will make that difference? How much of my donation will make the threshold? Absolutely. Question. Anything else that's come through? All right, great. Well, thank you, everyone.
Yeah,
If
thanks
there's
for
any
your time.
follow-up questions, I think Ben has our contact information right now.
Yep, I'll be sharing that as well. Thank you, everyone.
Great.
All right.
Have a good day.